Hey, good morning once again, options traders. Well, I received a really good email from one of our traders asking an intriguing question. Can you roll your way to riches? And what he's talking about is, can you go out and buy a call and then just right off the bat continually roll, continually sweep in credits until the amount of credits are greater than the amount that you paid? Now, to be clear, yes, this can be done if the stock price moves in your favor. That's the main reason that we do this rolling technique. But that's not what he's talking about. He means that you buy the call and right away just start rolling it. Is it possible to just roll your way into an overall net credit? A credit bigger than the amount that you paid for the option? Well, if it sounds too good to be true, you're absolutely correct. That would actually be an arbitrage, which are few and far between in the financial markets. But most traders don't understand why it's not possible. So let's go take a deeper dive and take a look at why you cannot roll your way to riches. And before we do, please be sure to click like and subscribe. It is definitely very much appreciated and helps so much to promote the channel. So before we get started, quick review on rolling for those of you who might not be familiar with what this term is. What you're doing with a roll is you are going to sell one option and buy another. And we will typically do this by rolling our call options up or rolling the put options down. Now we can do the reverse, but those are for different tactics. The main reason when traders talk about rolling, it is to generate credits, trying to sweep some cash off the table, but still stay in the position. And the way that we're going to do this roll is with vertical spreads. So for example, let's say that you buy a $100 call and pay $6 for it, and later the stock price moves in your favor, and you roll to the 105 call and you get a $4 credit. And it's this credit that's the reason behind the roll. And what will happen is that you've now spent $6 initially, you get a $4 credit. So on a net basis, you have $2 into the trade. And so if the stock goes against you, now you could only lose 2 instead of 6. That's the motivation behind it. It's more of a risk management move. But the way that you do this roll is by selling the 100-105 vertical spread. And again, you would effectively have $2 into the position. So here's why it's a vertical spread. We start out buying the $100 call, and at a later time, again, the stock has moved in our favor, we can sell this $100 call and buy the 105 call. So these two trades over here are a vertical spread. That's how you would enter it into your broker's platform. And once this trade executes, notice that these two positions cancel. So you would just be left with a long 105 call in the account that's still there to capture any potential upside. But at least you've received a $4 credit. It's kind of like doing a partial sale. And because of that, it now reduces our risk. And here's what it looks like graphically. Here's our initial $100 call at 6. Later, we roll it for a $4 credit. We shift from the red to the blue. Now, again, the main reason for this visually is that we're trying to raise this floor. This red line down here used to line up at -6. Now it lines up at -2. And so if the stock happens to fall below 105, now the most we can lose is 2. So it's an insurance policy. We're rolling this call up to reduce the amount we could lose. But as with any move in options trading, there's a cost. And we can see that the blue line is shifted a little bit further to the right compared to the red. So it's not going to be as profitable, but it's not done to increase profits. It's done to decrease the amount you could lose. We still have unlimited upside, and as the stock continues to move in our favor, we could roll at different times to continue sweeping money off the table. If we're able to roll from the 105 to the 110, maybe we can do this. And now look what happens. Now this green line, the entire green line sits above 0. And this is where traders will call it a guaranteed position, or maybe a call option better than free. A little bit of a misperception, which I've talked about before, but for this video, it's good enough. This is the main reason that traders want to roll. We spent 6, and right now we've collected $8, right? We collected a $4 credit, rolling to the 105, we collected another $4 credit, rolling to the 110, that's $8. So if you spent 6 and collect 8, now you've got $2 in your pocket. And so even if the stock now falls below 110, doesn't matter. We've guaranteed a $2 gain. So the question that this trader had is, well, do we really need to wait for the stock to move? Can't I just buy the 100 call and turn right around and immediately roll to the 105 and then roll to the 110 and just continually roll? Because each roll must produce credits. And so it seems like eventually we should be able to collect enough credits to offset, in this case, the initial $6 purchase. So that's the question. Can you roll to riches? Can you continually roll to produce credits and end up with guaranteed gains? So as I mentioned in the beginning, it's an arbitrage. And so the simple answer is no, you cannot do this. But again, most traders don't understand why, because it sounds like a good idea. Well, to see why it can't be done, let's jump over to an Excel spreadsheet and take a look at some option prices. Okay, so now we're into an Excel spreadsheet, and what I've done is I've taken 120 days to expiration, I put the stock at 100, and we're looking at different strike prices down this column. So in other words, with 120 days to expiration, the $60 call is worth $40. So it's trading at parity. There's $40 of intrinsic value and no time value. The 65 call, the pricing model says would be worth $35. Again, trading at parity. It's got $35 of intrinsic value and no time value. We drop down to the 70 call. It's basically at parity. It's got $30 of intrinsic value and just 2 cents of extrinsic, and so on all the way down the line. So in this next column, it shows the credits. And what this is looking at is that if you sell the 60 call for 40 and you roll up to the 65 for 35, all right, you collected 40 from the sale and then you spent 35 on the new option, that is a net credit of 5. If instead you rolled from the 60 call to the 70, you would receive 40 and then you would spend 30.02, and that would give you a net credit of $9.98. If you roll from the 60 to the 75, you would receive 40, you would spend $25.10, which would be a net credit of $14.90, and so on. But take a look at what happens. Eventually you just tap out. Eventually you hit a point where the very biggest credit you could ever get is $40. And that's exactly the price or the value of the call today. So where the illusion sometimes creeps in is that people just look at rolling, let's say, one row at a time. And they say, oh, I could get a $5 credit here. I could get roughly $5 here. I could get almost another 5 here. And then eventually I'm going to get maybe $3. And it just sounds like eventually you'd be able to more than make up that $40 cost. But we can see down here that you just can't. And so the easiest way to understand this is just look at it as one big giant roll. If you rolled from the $60 strike to the 170 strike, you would collect $40 from the sale, you would spend 0 effectively, and that would give you a net credit of 40, which is exactly the value of the call today. So that's why I sometimes call this a synthetic sale. It's not like you really just outright sold the option, but mathematically you really did. Because now this option is so far out of the money, it has virtually no chance of ever going in the money, so this is probably going to be it. You're probably going to be maxed out with a credit of 40, and you could have accomplished the same thing by just selling the call to close for $40. So the main thing to see is that we're not going to just buy this option and then roll all the way through within a matter of minutes and somehow roll our way to riches. Now let's take a look at these prices. I'm going to shift over to this graph. Here are the credits, and this is an easier way to see that yes, the credits start to accelerate, but eventually we hit a point where we just flatten out. It doesn't matter how high we decide to roll. That's again assuming the stock price hasn't moved. We're just going to max out at the current option value. And that's because eventually we hit a level where the options are trading for 0. But now let's look at it in an even more interesting way. What if we look at these prices? Those are the corresponding puts. If I had put the put prices up here, and instead of looking at strike prices, I looked at stock prices, we would see that the 170 put would be trading for 70. And that's because the stock is down here at 100. And that's exactly the price of the $100 call with the stock at 170. So another way to understand why this isn't going to work to just roll your way to riches, if you bought the 170 put, think about what's happening. You have the right to buy shares at 60 because that's a 60 call that you started with. If you buy the 170 put, you have the right to sell at 170. So if you can buy for 60 and sell for 170, that is a boxed position of $110, guaranteed $110. But we had to sacrifice the $40 for it. And so that becomes our cost. So 110 minus 40 is the $70. It's exactly the value of the $100 call with the stock at 170. So that's why I've always said many times that calls are puts, puts are calls. They're just two different ways of looking at the same graph. And the main thing to get from this is that it's so important to understand these pricing relationships, because once market conditions start to move, you have to make adjustments, at least most of the time. And you have to understand the hedges, rolls, and morphs, and you need to know where those values are coming from. And if you're not able to see it in terms of calls or puts, then you're going to struggle figuring out the best moves to make. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.